Whole life policy versus term life policy. Understanding the differences. When it comes to life insurance, two of the most common types are whole life insurance and term life insurance. Both offer unique benefits depending on an individual's needs, financial goals, and life circumstances. Understanding the differences between these two types of insurance policies is essential in choosing the right one for you and your family. This video will explore the primary differences between whole life insurance and term life insurance in terms of cost, coverage, benefits, flexibility, and more. 1. Definition of whole life insurance. Whole life insurance is a type of permanent life insurance, meaning it provides coverage for the entirety of the policyholder's life, as long as premiums are paid. It combines a death benefit with a savings or investment component, often referred to as the cash value. The cash value accumulates over time and can be accessed by the policyholder through withdrawals or loans. Because it lasts for a lifetime and builds cash value, whole life insurance is generally more expensive than term life insurance. 2. Definition of term life insurance. Term life insurance provides coverage for a specific period, or term, such as 10, 20, or 30 years. If the insured person dies during the term, the policy pays out a death benefit to the beneficiaries. However, if the policyholder outlives the term, the policy expires, and no death benefit is paid. Unlike whole life insurance, term policies do not have a cash value component. The simplicity of term life insurance makes it more affordable compared to whole life insurance. 3. Cost differences. Whole life insurance costs. Whole life insurance premiums are generally much higher than those for term life insurance. This is because whole life insurance offers lifelong coverage and builds cash value over time. The premiums are typically fixed, meaning they do not increase as you age or if your health deteriorates. A portion of each premium payment goes into the policy's cash value, which grows at a guaranteed rate over time, depending on the policy terms and the insurer. Term life insurance costs. Term life insurance premiums are significantly lower because the policy is temporary, and it does not accumulate cash value. Premiums are based on factors such as the policyholder's age, health, and the length of the term. A 20-year-old healthy non-smoker would pay much less for a 20-year term policy than a 40-year-old. However, once the term expires, if you wish to continue coverage, you may have to renew at a much higher premium, especially if your health has changed. 4. Coverage duration. Whole life insurance. As long as premiums are paid, whole life insurance provides coverage for the policyholder's entire life. This ensures that no matter when the policyholder passes away, their beneficiaries will receive the death benefit. This feature is particularly appealing to people who want guaranteed protection and prefer a policy that does not require them to renew or re-qualify based on age or health. Term life insurance. Term life insurance only provides coverage for the specified term length. If you purchase a 30-year term policy at age 30, your coverage will last until you turn 60. If you die within that term, your beneficiaries receive the payout. However, if you outlive the term, the coverage ends unless you opt to convert the policy to permanent insurance or renew it, which often comes at a higher premium. 5. Cash value and investment component. Whole life insurance. Cash value. One of the defining features of whole life insurance is its cash value component. As you pay premiums, a portion of the money is invested by the insurance company, and it grows tax-deferred over time. This cash value can be accessed through policy loans or withdrawals, although doing so may reduce the death benefit or the total value of the policy. Some people view whole life insurance as a combination of life insurance and a forced savings plan. You can even use the cash value to pay premiums later in life if enough has accumulated. Term life insurance. No cash value. Term life insurance has no cash value component. It is strictly a death benefit policy, meaning its sole purpose is to provide financial protection to your beneficiaries if you die during the term. There is no savings or investment element involved, and you cannot borrow against or withdraw from the policy. 6. Flexibility and customization. Whole life insurance flexibility. Whole life insurance is generally more rigid than term life insurance in terms of structure. While the premiums are fixed and predictable, you have limited control over how the cash value is invested unless you opt for more complex permanent insurance products like universal or variable life insurance. However, some insurers offer policy riders that can be added to enhance coverage, such as accelerated death benefits or long-term care coverage. Term life insurance flexibility. Term life insurance is very straightforward, and some policies offer more flexibility regarding renewal or conversion options. You may be able to renew your policy for an additional term or convert it into a permanent life insurance policy if your needs change, although this typically comes with higher premiums. Some term policies also come with riders, such as a return of premium rider, which refunds your premiums if you outlive the policy term. 7. Suitability for different financial goals. Whole life insurance. Whole life insurance is often seen as a tool for long-term financial planning. Because it provides lifetime coverage and builds cash value, it can be used for estate planning, leaving a financial legacy, or funding future expenses like college tuition or retirement. For people with complex financial situations, such as business owners or those with significant wealth, whole life policies can be a part of broader wealth building and tax planning strategies. Term life insurance. Term life insurance is designed to provide affordable, temporary protection. It is ideal for young families, individuals with dependents, or anyone with significant financial obligations, such as a mortgage or children's education costs, who want to ensure their loved ones are financially secure if something happens to them. Because it is more affordable, people often purchase larger death benefits with term life insurance than they would with whole life. 8. Pros and cons. Whole life insurance. Pros: lifetime coverage. Builds cash value that can be accessed during your lifetime. Fixed premiums that won't increase with age. Can be used for estate planning and wealth transfer. Whole life insurance. Cons: higher premiums than term life. Complex structure with less flexibility. Cash value grows slowly, especially in the early years. Term life insurance. Pros: affordable and straightforward. Ideal for temporary coverage during your working years. Flexibility to purchase larger death benefits. Term life insurance. Cons: coverage expires after the term ends. No cash value or investment component. Premiums increase significantly upon renewal, especially at older ages. 9. Which policy is right for you? Choosing between whole life insurance and term life insurance depends on your financial goals, your budget, and your need for long-term coverage. If you are looking for affordable coverage to protect your family while you have significant financial obligations, term life insurance may be the better option. On the other hand, if you want lifelong coverage, the ability to build cash value, and are willing to pay higher premiums for that benefit, whole life insurance may be a better fit. Some people opt for a combination of both, starting with term life insurance when they are younger and converting it to a whole life policy later, or adding a whole life policy as their financial situation improves. To sum up, whole life insurance and term life insurance serve different purposes and appeal to different types of policyholders. Whole life insurance provides permanent coverage, accumulates cash value, and comes with higher costs, while term life insurance offers temporary, affordable protection without a savings component. Understanding these key differences will help you choose the life insurance policy that best suits your needs and financial situation. Always consult with a financial advisor or insurance professional to tailor the best solution for your individual circumstances. Thanks for watching. Please subscribe.